CFA Level 1, Level 2, Level 3, and CHI Level 1 Edge Study Program for the 2022 exam cycle. This is video 2 of the Standards of Professional Conduct, Guidance to the Standards. We're carrying on. We've already covered the first 2 standards. Okay, Standard 1, Professionalism, which contained 4 topics: knowledge of the law, independence and objectivity, misrepresentation and misconduct. We've also covered Standard 2, which is integrity of capital markets, which had 2 substandards: material non-public information and market manipulation. We move on a little bit over here, guys, to standard number 3, duties to clients, loyalty, prudence, and care. Okay. Members and candidates have a duty of loyalty to their clients and must act with reasonable care and exercise prudent judgment. Members and candidates must act for the benefit of their clients. And look over here, guys, this is very important. Who comes first? And place their clients' interests before whose? Their own and that of their employer as well. Okay. You come last. Okay. Let's look at some guidance. Okay. Who is loyalty, prudence, and care to be applied to? Okay. The standard requires members to act with loyalty, prudence, and care towards generally client, contracts, and relationship. Okay. The level of a fiduciary, if you just talk about a fiduciary, okay, that's a higher level of trust, okay, than your stock standard client relationship. Okay. Very important, guys, is to identify the actual investment client. Who is the actual client who we're dealing with, and of course to whom the duty of loyalty, prudence, and care is owed. Okay, and sometimes it's easier to see, sometimes it's less easy to see. Okay, developing the client's portfolio. Okay, the goals and objectives of the manager must be in line and in the best interests and objectives of the client. Okay, you must follow any guidelines that your client has given you, okay, for the management of their assets. Okay. We talk about soft dollar, soft commission, soft dollar policies. And what is a soft dollar or soft commission policy? Okay. For example, if brokerage services generally cost 0.5%, okay, the manager may be inclined to spend 1% on brokerage. Why does he spend a little bit extra? Because he's purchasing research services from the broker. Now, this would be allowed if those additional research services and benefits that he purchases for the extra 0.5%, okay, if they benefit the client, okay, but not if it benefits other clients of the firm, not the specific client, and not if it benefits the manager alone. Okay, proxy voting. Proxy voting, remember that a wealth manager, an investment manager, often gets to vote the votes of his client. And of course, these votes have an economic value to the client, and they must be voted in an informed and in a responsible manner. Okay. In addition, the members should disclose the proxy voting policies to their clients. Over the page over here, let's go. Okay. Recommended procedures for compliance, regular account information. Okay. Number 2, client approval. Okay. When in doubt, get approval from your client. Should be policies in place, okay, from the firm that put clients first. Establish the investment objectives of your client. Okay, consider all information when taking actions. Things like, what are your client's needs? What are his circumstances? What are his basic characteristics? What is the characteristics of the total portfolio? Diversify. Okay. Carry out regular reviews. And guys, when you talk about regular reviews, that's a minimum of an annual review. Okay. Deal fairly with all clients with respect to investment actions. No clients to be favored over another. Disclose any conflicts of interest, disclose any compensation agreements and arrangements. We'll see all those as we go forward. Vote proxies and vote them properly and responsibly. Maintain confidentiality of the process. Seek best execution for your clients. And of course, guys, place your clients' interests first. We look over here, guys, top of page 28, application of the standards of 3A, loyalty, prudence, and care. Let's have a look over here. Let's pick number 1 again. Okay, good. Bongani is a trustee for the pension plan belonging to a company called XXX. Okay, they are now the subject of a takeover bid. In an attempt to ward off the bid, XXX asks Bongani to buy stock in the market on behalf of the pension plan. He believes that the stock is overpriced at the current level, so he wouldn't ordinarily buy, but he buys the stock anyway because he was told to by XXX and he wants to keep them happy. Okay, the stock price of XXX rises, so in fact it was turned out to be a very good investment decision because the stock price of XXX went up anyway, and the takeover bid is averted. Okay. Has he violated standard 3A? Yes, he has. Why? Because he did not act prudently and in the interests of the pension plan. Okay, it wasn't a good purchase. It happened to work out, but it wasn't a good purchase, and he would not have purchased them ordinarily. Okay, what should he have done? He should have evaluated the prospects of the takeover deal more carefully. Okay, his key responsibility, and guys, remember what we said a little bit earlier, you always need to determine in terms of standard 3A, loyalty, prudence, and care, to whom the duty of loyalty, prudence, and care is owed. Okay, and over here, the duty is owed to who? To the participants of the pension plan, not to company XXX. It's the duty of loyalty, prudence, and care is owed to the plan participants. Okay, over we go. A few more examples over there, guys, and we come now to standard 3 duties to clients. 3B, fair dealing. Let's talk about fair dealing now. Members and candidates must deal fairly and objectively with all clients when providing, and guys, we've seen, I said this is something we're going to see more and more often, when providing investment analysis, making investment recommendations, taking investment actions, or engaging in any other professional activities. There we go. Okay, let's look at the guidance over here. Clients must be communicated with on a uniform basis. In other words, fairly, everyone at the same time, not some clients ahead of others. A fair and equitable system needs to be designed to prevent selective or discriminatory disclosures to clients. Okay, specifically, of course, when members change their recommendations. So if you initially had a buy order out, now you think it's a sell order, well, then you better communicate that evenly and uniformly to all of your clients. Okay, what does fairly mean? Okay, fairly means treating all clients equitably, but look at this, in light of their investment objectives and circumstances. So it doesn't mean that you can't give someone more than others, okay? And also doesn't mean that you can't give one and not the other, depending on what the particular portfolio circumstances are. Okay, by way of example, okay, let's say, for example, we use this as our stock standard example, guys. Okay, you have got 2 clients in your firm. You've got client A and you've got client B, and let's look at their contributions to your firm. Client A contributed 99 million and client B contributed 1 million. Now you get a hot IPO which is oversubscribed, and you, as the member, happen to get, for your firm, you get 100 shares, 100 stocks. So first of all, of course, you can't take any, because remember what we said, okay, that in terms of loyalty, prudence, and care, you've got to put your clients in prospective clients ahead of you. So you're getting none, by the way. But would it be fair to then get to say, okay, well, of those 100 shares, I want to give 99 to A and 1 to B. Why? That is that's how I'm allocating, because that's how I allocate over subscriptions or anything for that matter. Okay, and it's a fair way of doing it because that is the way that they've contributed capital towards my firm. Is that a violation, or is that okay? Are we in line with fair dealing? And yes, we have treated them fairly. Okay, why? Okay, because first of all, we say, well, we look at customers and we say, are these shares, these 100 shares that I've got, number one, are they appropriate for A and B? Yes. So now I've got to say, okay, they are appropriate for A and B. And let's say, for example, I had member number C who was that was not appropriate for example, it was too risky for them. Of course, they wouldn't get any because that's not appropriate for them. I don't have to give to everybody. I've only got to give to those clients that it is appropriate for. Okay. Then I've got to say, okay, well, now that I've decided and I'm aware of who the shares are appropriate for, Mr. A and Mr. B, okay, now let's give it to them in a way that is fair, a fair allocation method. And a fair allocation method, yes, would be in line perhaps with assets under management. But the trick over here, guys, is if that is then your allocation method, stick to it. Okay, you can't keep changing it. You can't say, well, next period, I think I'm going to allocate based on 50-50. And then next time, well, you've got to be consistent. So yes, pick an allocation method that is fair, which this is a fair allocation method, and then apply it consistently. Okay, some recommended procedures for compliance. Develop firm policies with respect to allocations and things like that. Limit the number of people involved. Okay, shorten the time frame between decision, you make a decision, and dissemination. Publish guidelines for pre-dissemination behavior. Do simultaneous dissemination in order to treat everybody fairly. Make sure everything gets disseminated at the same time. Maintain a list of clients and their holdings. In other words, what each client holds, what is appropriate for each portfolio. Develop and document trade allocation procedures and stick to those. Here are some written allocation procedures which include all orders to be time-stamped, sending them out on a FIFO basis, first in, first out, things like that. Okay. Disclose your trade allocation procedures that everybody can see it and it doesn't change and it's fair. Establish systematic account review and disclose levels of service. I just want to talk about this last one for a second. Okay. Are you allowed to say, okay, well, in my firm, we've got 2 service levels. Okay. You've got platinum. You can buy the platinum package or you can buy the silver package. I don't know. Okay. The platinum package costs you $100 per month. The silver package costs you $50 per month. What's the difference? Well, the platinum package, you get 10 research reports, whatever. The silver, you only get 2 research reports. Is that fair? And whatever other kind of service levels you want to differentiate, that would be fine. And the reason that would be fine, of course, guys, is because you're able to differentiate. You can say, okay, if you pay for this, this is what you get. If you pay for that, that's what you get. And that, of course, would be allowed. You're treating everybody fairly, okay, based on what they pay into the firm. Okay. Just watch for that one. They do like to ask that. Top of page 32, we see over here, guys, the application of the standard. Let's have a look at the first one again. Okay. Jimmy is a banks analyst. He has just finished writing a report on a small bank called Wildly Profitable. He's going to recommend a strong buy on this bank as it's secured many government contracts. He plans to release his report on Friday. The Monday before that, he has breakfast with some of his best clients and he lets them know about the company and his recommendation to release on Friday. Of course, guys, this would be Jimmy has violated standard 3B fair dealing. Why has he violated it? Okay, because he has not treated clients the same. Okay, and he's given out his recommendation report to his best clients before disseminating to everybody else. Okay, that was, of course, a nice and simple, easy one to see, but there we go. And as you can see, guys, I've given you a ton of little examples, applications over here. Just a reminder, guys, these come directly from the CFA textbook. Okay, but of course, I've just culled them to make them a little bit easier and more readable. So, of course, that would make it a bit easier for you guys. There we go. Okay, guys, we now move on. It looks like a big one, but it's actually not such a big one. Standard 3, duties to clients, suitability. Okay. When members and candidates are in an advisory relationship with a client, they must. Okay, now we break this standard down. The standard which is called suitability. In other words, what is suitable for each client? We break this down into 2. The first one is when members and candidates are in an advisory relationship with a client. In other words, they advise the client. The client asks them for advice. They advise. They invest on behalf of the client, etc. Okay, that's number 1. Number 2 is when members and candidates are responsible for managing a portfolio to a specific mandate, strategy, or style. In other words, it's not discretionary, it's not advisory. They are told what to do. They are told, please Okay, just track the S&P 500. Please track the gold index or anything of that nature. Two very different ways we are going to handle this particular standard, guys. Let's start off with the first one. Of course, there's more to be said surrounding an advisory relationship than there is management to a specific mandate. We start off over here. When managing according to an advisory relationship, number one, members must make a reasonable inquiry into the client or the prospective client's investment experience, okay, risk and return objectives, financial constraints, before making, guys, you've seen this, before making any investment recommendation, investment action, etc., etc. And look over here, this is when we see it. They must reassess and update this information regularly. When we talk about regularly, guys, we talk about at least on an annual basis, and before that if something changes. Okay, B, determine that an investment is suitable to this client's financial situation and consistent with that client's written objectives, mandates, and constraints before making investment recommendations or taking investment action. And C, judge the suitability of the investment in the context of the client's total portfolio. An interesting one over here, just by way of a little example, okay? We talk about B, that it must be suitable to the client's financial situation. So let's say, for example, I've got a 100-year-old, okay, granny. Okay, now, she's no longer working, okay, but she's built up a little bit of capital in order to sustain herself for however long she will still be around for. We hope it is long. Okay, and she reads, she's a very funky and excited granny. Okay, she keeps up with the times. She's not she doesn't you know, and she's healthy and etc., etc. And she's in the market for cryptocurrency. Wow. She phones you as her investment advisor and she says, do me a favor, okay, put me into cryptos. So you say, well, you know, it's not suitable for you because we really need to keep you in fixed income because we need to make sure there's sufficient income for you for the remaining part of your life because you can't go back to work, and you explain to her, etc., etc. Okay, now, so quite clearly, guys, in terms of standard 3C, and if I'm looking at particularly point number B, no, crypto is not suitable for Granny's portfolio. Okay, now, what happens if Granny says to you, okay, I concede, okay, but do me a favor, give me 1% in cryptos. So keep 99% in fixed income, okay, but 1% at least for me in cryptos. Would that be okay? Okay, and when we move now to point number C, probably it would be okay. Okay, if it's a contained 1%, in other words, it can't spread, and we don't do any tricks like leverage or margin trading or anything like that with a trade, and we just stick it perhaps just to the 1%. Then we say, judge the suitability of the investment of this crypto in the context of the total portfolio. Well, the other 99% is sitting in US Treasuries, which is highly secure, we think. Okay, 1% in cryptos is not a train smash. Would seem to be okay even for Granny. Okay. We now move to point number 2. When members and cans are responsible for managing a portfolio to a specific mandate, strategy, or style, they must only make investment recommendations or take investment actions that are consistent with that stated objective and constraints of the portfolio. So if you're told to manage according to the S&P 500 as a tracker index, of course, guys, that is what you must manage according to. And of course, we expect you to have, on that basis, a very low tracking error, because supposedly you are a tracker fund, supposedly it's a passive investment. You're managing according to a specific mandate. Okay. Let's look at some guidance over here. Okay. Number 1, we're talking more in terms of advisory clients, developing an RPS. An RPS is an investment policy statement, okay, for your clients, okay, taking into account things like the client's financial circumstances, personal data that's relevant to them, attitudes towards risk, and objectives in investing. Okay, and please come back, everybody, to do a lovely section in CFA level 3 when you get there, because that is when we really focus on clients RPSs, and all this kind of good stuff. Okay, good. Understanding the client's risk profile. Okay, some of the key things we need to update, guys. We need to understand the client's tolerance for risk. Are they a risk seeker? Are they risk averse, etc.? Updating the policy, okay, at least annually or when there's a material change. And a lovely point on this is what happens, for example, if your client wins the lottery. They were an average working class human being, and then they went ahead and they won the lottery. So quite clearly, guys, this will be a material change. Do you need to be updated and surf social media sufficiently so that you'll be able to pick up on all of these kind of things? Or, okay, listen, you phone him annually, that's what you normally do, and this happens somewhere in the middle of the year. Well, if he phones you to tell you about it, well, then that's good. If he doesn't, well, you'll catch up with him annually. Okay, or have you violated this particular standard? And the answer to that is no, you haven't violated. You don't have to actively track all of your clients and read the newspapers and make sure that every single thing like that gets out. Of course, if it's a massive event and everybody knows about it or should have known about it, that might be a little different. Okay. In terms of the standard, guys, okay, in terms of suitability, of course, there will be the need for diversification. Watch for that. Okay. Now I want to take you through a lovely set of scenarios. We go back to Granny. Let's talk about Granny again. And when I talk about this, I've put together this little slide for you, this little flow chart, okay, addressing unsolicited trading requests. What happens if we get requests from Granny, okay, that are not reasonable, etc.? Okay. Let's have a look. So the member receives an inappropriate trading request from their advisory client. Guys, are you happy that it's an advisory client? Okay. So Granny phones and says she wants 50% of her portfolio to be put into crypto. The other 50 she wants you to invest in NFTs, non-fungible tokens. Okay, some interesting stuff out there now, guys. Okay, so we move to the right. The member should first discuss their concerns with the client. Talk to your client. See if you can come to any kind of reasonable explanation and what they want, why they want, and why it's not appropriate for them to be in those investments. Okay. Move down. Will the transaction have a material impact on the portfolio? If the answer is to that is no, like we spoke about earlier, that's 1% of the portfolio. It's not a material impact. Okay, then go ahead and trade for the client. Keep Granny happy and get her into a little bit of crypto. What if it will have a material impact on the portfolio? So yes, it will have a material impact. Okay, you ask them now, you say to the client, are you prepared to make the change to your RPS to reflect the fact that you are no longer seeking low risk investments, you are no longer seeking things like that? And they say yes, no, I'll change it for you. Then yes, update the RPS, take into account the changes, and then perhaps go ahead and trade for the client. Okay, good. Okay, what if no? The client says no, I want my RPS to remain the same. Okay. What you might want to do, and I don't suggest this, I don't recommend this, but can a new unmanaged account be created for this trade? So let's try and put this in a bit of a side thing. And if the answer to that is yes, some firms, I'm not sure how many, but some firms may allow this trade to be executed in a separate kind of unmanaged account. And my advice to you is the second part. Many firms terminate the relationship with the client because this is too risky, guys. Okay, just too risky. That would be my advice. But no one asked me, so we follow the rules over here. Okay, what if a new unmanaged account cannot be created? Okay, well then the firm will need to decide, do they continue with the client or not? Okay, so it's a lovely little flow chart over here, guys, where you can see quite clearly exactly how to manage the specific process of what we call, guys, unsolicited trading requests. Okay, and you're going to get these, by the way, because there's times in the market gets a little bit exciting, everybody wants to trade, everybody, etc. Okay, managing, and this was obviously the second part of the particular standard 3C suitability, managing to an index, okay, or a mandate or anything of that nature. Okay, when members are responsible for managing to an index, okay, or a mandate, the responsibility is to invest consistent with the mandate. Simple as that. We talk on top of page 36, recommended procedures for compliance. Okay, when you look at an RPS, an investment policy statement, what should be in that statement? Okay, Client identification, identify the client. Investor objectives, we talk about 2, return and risk must both be addressed. Investor constraints, things like liquidity, cash flows, time, tax, regulatory, specific investor preferences and proxy voting, etc. Performance measurement benchmarks, okay, update those regularly, and suitability test policies should be in place as well, just to test that all clients are being treated in the correct manner. Top of page 37, we see application of the standard. Okay, let's have a quick one over here. Number 1, Edwin has 2 clients, both of whom earn the same salary. Harry's 65, and he's built up a large amount of assets over many years, and he's wishing to invest aggressively, Harry, but he's got a very large asset base. Larry is just starting out. He wants conservative growth for his portfolio. Edwin invests 40% of both portfolios into junk bonds. Okay, and of course, this is not suitable. Okay, and one would have to see, well, definitely it's not suitable for Larry. And why is it not suitable for Larry? He's 25, and he's quite actively and purposefully said that he wants to only invest in conservative stocks. So don't put him into 40% into junk bonds. That's clearly a violation of suitability for Larry. Edwin, okay, he does want to invest aggressively. He is 65, and perhaps because he's got a large asset base, okay, might be okay. That would be a bit of a question. Okay, but you can't treat them the same, of course. The question we would be left with over here, has he violated for Harry at age 65 going into junk bonds? And my only question over here would be, is Harry not a bit advanced in age, okay, that he shouldn't be going into these kind of things, and he should recommend against that? But on the other side, I would argue that he has built up a large asset base, so he's seemingly to be quite comfortable. There we go. Okay. Over our page, we can see there's more questions over here. Questions, and away we go to top of page 39, guys. Standard 3 duties to clients. 3D, performance presentation. What is performance presentation? Nice simple one, guys. When communicating investment performance information, in other words, your results, members and candidates must make reasonable efforts to ensure, okay, that it is fair, accurate, and complete. And often we just use the acronym FAC, fair, accurate, and complete. Okay. How would we do this? Okay. The key to doing this, guys, I'm just going to skip ahead over here. Recommended procedures for compliance is GIPS. Okay. Apply the GIPS standards. What are the GIPS standards? GIPS standards are the Global Investment Performance Standards. Okay. And these are the global standards that we use for investment performance. Okay. Let's go back to the guidance over here. What does the guidance say? Members are required to provide credible performance information to their clients and to their prospective clients. Okay. They are required to avoid misstating performance or misleading clients, okay, about their investment performance. Okay, there we go. Okay. Compliance without the GIPS standards. Can you meet this particular requirement, performance presentation, and not comply with GIPS? Yes, you can. Okay, but you must take into account the knowledge and sophistication of your audience when you are presenting performance. Don't go into a presentation, guys, with unsophisticated investment people and start to talk about detailed standard deviations and VARs and tracking errors and things like that. Okay. Okay. Presenting the performance of a weighted composite rather than using a single representative account. Okay. Including terminated accounts. Okay. As part of the history should be done as well. Make disclosure that fully explain everything. So you don't have to comply with GIPS. Okay, but then you need to do all of this as well. Maintain data and records that are used to calculate records and performance, etc., etc. Okay, and of course this standard is much better handled directly by looking at the GIPS, the Global Investment Performance Standards. Okay, let's have a look over here. Okay, number 2. Ashley calculates the returns on her funds from 1998 until 2005. Her calculation is accurate and complete. Okay, which is exactly what we wanted. She also claims compliance with GIPS. However, her composites, and what are composites? We'll see this much more when we see those that want to study the GIPS section, okay, are the various portfolios within her that she manages. Let's say, for example, domestic equity portfolios, global bonds, all the things like that. But that, and hers are not asset weighted. Okay, based on that, she's violated standard 3D performance presentation. Yes, her calculations are correct. Okay, but she can't claim compliance with GIPS until her composites are properly asset weighted. Okay. There's some more examples for you over there. Do take a look at those, and as you can see, there are many of those. Okay, let's have a look at 3E. 3E is the last one that relates to duties to clients. Okay, preservation of confidentiality, 3E. Members and candidates must keep information about current, and look at this, guys, not just your current guys, okay, but about current, former, and prospective clients confidential unless you've got three that you need to consider. The information concerns illegal activities on the part of the client, disclosure is required by law, or you've got permission, the client or prospective client permits disclosure of the information. In terms of the guidance, in the event that the client is involved in illegal activities, the member may have an obligation to report the client. Okay, good. Recommended procedures for compliance. Okay, if a member wishes to make disclosure, he needs to ask the following questions. What context was the information disclosed in? Was it work-related? Okay, is the information background material that will enable the member or candidate to improve service, okay, to the client? Okay. We look over here, guys, and this brings us then to a close of duties to clients, which is your longest standard, by the way, containing 5 separate substandards. Okay, and let's pick up number 2. Muhammad is an investment advisor. One of his big clients tells him that he's planning to give away $1 billion. Wow, must be a Bill Gates of sorts, to an educational institution. Muhammad calls his friend at Serious Education and tells her to call the client and ask for a large donation. Okay. Now, of course, we're considering 3E here, preservation of confidentiality. Okay, and Muhammad has violated 3E. Why? He can't give any confidential information because one of his big clients told him what he's going to do, but you can't tell that to other people. Okay. Now, and remember, guys, how did Muhammad receive the information? He received the information within the scope of a confidential relationship with a client. And perhaps if Muhammad had received the information, let's say, for example, he was just friends, perhaps, not a client, with this other big client, and they were having a cup of coffee together, and the client and the big donator, the big donor, said to him, listen, I'm planning on giving away $1 billion. What do you think? Yeah, I think it's a nice idea. Sure, that's so nice, so kind of you, etc., etc. Okay, that may be a different story because that is not within the scope of a confidential client relationship. So just watch for that one as well, guys. Okay, and that was the end of standard 3. We move ahead over here, guys. Okay, page 44. Okay. Standard 4, this is a massive one, particularly standard 4A, duties to employers, and it is the duty of loyalty. This is a very, very, very big one. Okay, let's go. In matters related to the employment, members and candidates must act for the benefit of the employer, first of all, not deprive the employer of the advantage of their skills, abilities, and they may not divulge confidential information or otherwise cause any harm to the employer. Okay, let's start off here, guys. This is an important one, and this is where I can almost guarantee you lots and lots of questions coming out of this one. Employer responsibilities. Employers are not obligated to adhere to the code and standards. Okay, so they don't have to. You are the employee, so you have to. Okay, Senior management, just a side point in terms of the employer's responsibilities, being senior management, okay, they must design compensation structures that don't encourage unethical behavior, which unfortunately is often prevalent within the financial markets. Independent practice. Members are not allowed to engage in independent competitive practice to conflict with that of the employer. Look over here, this is important. So you cannot compete with your employer unless you get consent from your employer. So you say to your employer, listen, I know you're a pension fund manager, but I want to manage pension funds myself in my spare time on the weekend, Saturday and Sunday. Okay, you can't do that unless, of course, you first get consent from the employer. The big one, leaving an employer. Okay, when you leave an employer, members must not engage in any competitive activities with their employer until such time as you are fully resigned. You've left. Okay, things like don't misappropriate trade secrets. Okay, don't misuse confidential information. Don't solicit their clients before resignation. Self-dealing, misappropriation of clients or client lists. Now look at this one. There's an interesting one. What does it say? So don't solicit clients before you resign. But now that you've resigned, let's say, for example, you're sitting at your desk the very next morning, post-resignation, you're not really sure what you're going to do because, okay, you've got no clients. Okay, so what can you do? You're allowed to, okay, pick up the phone and you say, well, who are my old clients? Oh, Mr. A. Let me phone Mr. A and Miss B. Let me phone them. But remember, when you leave the employer, you can't take anything with you. So you don't have their numbers. So you check on Google, I don't know where you check, you find their numbers. And then you phone them and you're asking for their business. That's completely allowed, guys, because you didn't take their details with you. You remember them. They cannot restrict what's in your brain or your mind, guys. So what you've got with you, you can take with you, etc. as you go. So as long as you don't misappropriate anything, once you've left, those clients are not off bounds for the rest of your lives. Okay, good. Okay. When planning to leave, an employee must not contact your existing guys, okay, with the intention of soliciting business. So the best thing to do is when you're planning to leave, write an email telling all of the people that you worked with for the last many years, okay, that you're planning to leave. Best practice would probably be to let your boss have a look at that to make sure that he's not uncomfortable with it. Just to really, it's an informative letter. Just today it's probably on LinkedIn or it's probably on any other strange form of social media. Okay, but get that checked first and don't solicit business with that. Okay, all skills, this is an important one, guys. All skills and experience that an employee obtained while employed can be used in the new employment. So let's say, for example, they taught you in your old job how to do modeling. Well, you can take that with you. You're not expected to not have learnt anything in your old employment. Use of social media. All firms' policies, regulations regarding the use of social media platforms, etc., must, of course, be adhered to. Okay. Whistleblowing, what's that? Okay. There are times when members must act contrary to their employer's interest in order to comply with their duties to the market and clients. Okay. Nature of employment. Okay. Okay. Members must determine whether they are employees or independent contractors, okay, to determine whether or not the standard in fact applies. We talk over here, guys, recommended procedures for compliance. In order to comply with the standards, it's good to have a competition policy in place, a termination policy in place, and a policy to be able to classify employees. Over the page over here, let's have a quick look at a question. Yeah. Okay, Wahab is in the process of leaving his old employer to join a new employer. Okay, Wahab convinces 5 current clients and 7 prospective clients, okay, to join him at new employer. Of course, he has violated that, okay, because once he's employed still there and he's in the process, look at the words, he's in the process of leaving, he hasn't left yet. If he had left already, then yes, he can approach those clients and prospective clients as long as he doesn't steal client lists and things like that with him as he leaves. Of course, that would not be allowed at all. That's the application of the standard, guys. That is Okay, a very, very important one, standard 4A, loyalty. We go over the page over there, and you can see lots and lots and lots of little questions over there. Okay, wow. Okay, 15 for you to do. Let's have a look at top page 49, duties to employers, additional compensation arrangements. Okay, and this one, by the way, I always like us to go back and have a look at standard 1B, which is independence and objectivity. Remember, independence and objectivity also spoke about candidates must not offer, solicit, accept any kind of gifts or things like that that would reasonably compromise their independence and objectivity. How does this one change? Let's have a look. Standard 4B, additional compensation arrangements. Members and candidates must not accept gifts, benefits, compensation, or consideration that competes with or might reasonably be expected to create a conflict of interest with their employer's interest. And look over here, guys, just follow this carefully. Unless they obtain written consent from who? Everybody. Not just from the employer, but also from the person that you're doing the work from, the additional compensation that you're doing the work for. Get written consent from them as well. Okay, that's the guidance as well, guys. Recommended procedures for compliance. Members should submit a written report to their supervisor, compliance officer, that details any compensation they propose to receive for services in addition to the compensation they receive from their employer. Okay, let's have a look at a question over here. Question number 1, application of the standard. Okay. Leonie works for an investment firm. She gets paid a salary for her work. One of the benefits, one of the clients of the firm offers her a large bonus if she achieves more than 12% growth on their portfolio for the year. Okay, and Leonie doesn't tell her employers about this additional bonus. Okay, quite clearly this additional 12% would be classified as additional compensation. Okay, and would bring into play, okay, standards 4B, additional compensation arrangements. And of course this would be a violation. What should she do? Okay, she would need to get written consent from all parties concerned, and of course she would need to inform, when she gets the written consent, by doing that she will then have informed her employer. Okay, there's a few more questions over there under the application over there, guys. Okay, not too big a standard. Okay, this one is a bit of an interesting one. The last one of standard 4, duties to employers. Okay, let's have a look over here. Okay, responsibility of supervisors 4C. Look at this one. This is a very interesting one. Members and candidates must make reasonable efforts to ensure that, and look at the words over here. Do you see what this says? That anyone, okay, not just fellow CFA charter holders, fellow CFA candidates, but anyone subject to their supervisional authority complies with all laws, rules, regulations, and the code and standards. Now, you've got a very strange situation that's cropped up here. You may well have a case now, guys, okay, where you've got people that are working for you, okay, that have no interest in CFA. They can't even spell CFA nor have any interest in it whatsoever, yet you have to make sure that they keep to the CFA code and standards because you are their supervisor. Okay, that's a bit of an interesting one. So supervisor, we can see over there in terms of the guidance, is an important one. Okay, and of course then, guys, members acting as a supervisor must have in-depth knowledge of the codes and standards. Okay. Effective compliance systems would include things like a code of ethics, compliance policies and procedures, education and training programs, incentive schemes that reward ethical conduct. Okay. Detection. Okay. Supervisors must also make reasonable efforts to detect violations. You can't just say, well, yeah, I don't know about it or anything like that. You need to put specific things in place to be able to detect as well. We look over here, guys, recommended procedures for compliance. What are some of those that should be in place? A written manual. The manual must be easy to be understood. Designate a compliance officer with clearly defined authority. Ensure that the compliance officer has sufficient resources at his disposal. The supervisory hierarchy must be in place. A system of checks and balances in place, monitoring and testing of the procedures. Permissible conduct must be outlined, okay, and violations and sanctions must be set out. What happens there? Once a compliance procedure is in place, the supervisor should disseminate the contents to appropriate personnel, keep the document up to date, educate personnel regarding the compliance procedures. Okay, a professional conduct evaluation should be incorporated as part of the employee's performance review. The actions of employees must be reviewed, and procedures must be enforced in the event, of course, that a violation has occurred. Now, top of page 51, if a violation does occur, the supervisor must or should respond immediately, undertake an investigation, determine what went wrong, limit the offender from doing anything further, okay, and make any changes that may be necessary. Okay, regular ethics and compliance training should be in place. Okay, people say, well, okay, there's no time. Well, what won't we train our people on? Ethics. Why? Because, okay, that's the last thing that we focus on. Okay, and the incentive scheme of the firm should encourage ethically appropriate conduct. Okay, we look over here, guys. Okay, and let's have a look at, on top of page 52, application of the standard. Number 3. We're just picking them randomly, no specific order, of course, guys. Kanye is a supervisor at an investment firm. She notices strange activities going on in the trading division, but does nothing about it. As part of her salary is tied to the benefits of the trading department. I was just recently giving a lecture to a group of guys on financial disasters, and one of the disasters that we were talking about was Barings Bank. And Barings Bank was an interesting one because it came out that post the failure of Barings Bank, that the management team in London that kept on sending further and further liquidity through to Singapore to their trader Nick Leeson, okay, had no idea what was going on. But worse than that, okay, that the type of trading that he was telling people he was doing, and telling management that he was doing, shorting straddles, and he was long the Nikkei 225 using arbitrage, okay, should never ever have been able to generate those massive profits that he was telling them about. So it was impossible to generate that level of profit for that type of trade. Yet he was reporting massive profits. Management was happy, and they kept sending him money. And again, the same story, okay, when people are seeing profits, tends to blind them just a little bit, as you can see in the question here. Let's carry on. Okay, so has Kanye violated standard 4C responsibility of supervisors? She has, because she didn't adequately supervise the actions of the trading department for which she is responsible. Okay, and remember, she should be mindful of both her roles. Okay, she's got a supervisory role and that of her remuneration role as well. She needs to be mindful of both of those. More questions over here, guys. We look at the standards, application over there, takes you all the way down there. Okay, and guys, that brings us then to a close of standard 4, duties to employers. Okay, we've now covered the first 4 standards. Okay, we will close off our class at this point in time because we have done quite a bit of work thus far, and we will continue with the third and hopefully the last lecture on the standards of professional conduct, where we will cover standards 5, 6, and standard 7 coming up.